Okay, so let's start. And Our topic, as I mentioned before, cash and liquidity management. Liquidity management. Now, it's important when we discussed last time the short-term financing or short-term financial planning, in which one aspect is that we have to make a cash budget in order to see how much cash we required during the quarter and then analyze, and we can borrow short term from the money market or from financial institutions for short term basis, and then cover if there is a deficit, and if we have a surplus we can invest in the into market where we can convert it easily into cash. So that's a one aspect what we discuss in our last class or last lecture. Now we gonna focus on cash and liquidity management. Uh, Now one point I must make it clear for all of you here. Many things what we are gonna discuss is not right now with the invention or introduction of a online banking system or with the we call it as a real-time settlement of accounts. Now, these techniques are considered to be little obsolete, but why it is important to still continue to study is that to see that how these can impact the cash inflows and cash outflows. But because of this innovation, now these things are going to be eliminated. So in order to understand the importance of these real-time online banking type of thing, we must understand that previously how it was conducted, what are the advantages of doing, or how they can utilize or manipulate those ways of doing business, and right now where. But still there is a some adjustment or a cycling period, which even the transactions are going on real time, but there is a process, we call it as an adjustment process at the end of the day. So we can see that, and it takes sometimes more time than that to come to our account. Like for example, if you go and to any grocery store or any store, retail store, if you return something, the money is not immediately coming to your account. Although when you transact to buy something, your amount is immediately deducted from your account. But when you go for a return, the amount is not immediately returned. It takes about 2 to 3 days. Normally, they said 5 business days. So why is it like if it is a, in real time online banking, then why not should? So we will talk about these things in detail in this chapter. So why I put this in the beginning, that nowadays the system and innovation make these things a little bit obsolete, but it is still relevant, not to ignore it. Let's start. What are the key concepts and skill sets what we are going to learn here? Understand the importance of float and how it affects the cash balances. The main objective of introducing this preamble is that float is an idea, or float is a concept that gives us something like the money is in float. The money is in float means that it is not in your account, but it should be in your account, or it is you are expecting that it is going to be in your account in a very short period of time, or the money which is in your account, but it should not be there. It should be very soon going to be deducted from your account or extracted from your account, is again a float. So there is an disbursement float or there is a collection float. So collection float is that money you are expecting that it should be in your account, but not still in your account. That is a collection float. And there is a money which you are saying that it should not be there in your account, but it is still there. That's what we call it as a disbursement float. For example, I don't know how many of you experienced, but I experienced it that if I make a payment to my BC Hydro bill through my online banking, or I go to the BC Hydro account and put my debit card details here in that account and make payment. So payment is not immediately deducted. The payment is going to be deducted next day or day after. So it means that my disbursement float is there, right? Because my balance is appearing like it's not deducted. But in my account, in my own books, I say that, oh, this is already I paid payment for that. So that's a difference between collection and disbursement, or that's just to give you a personal idea of float. Know how firms manage their cash and some of the collection and concentration and disbursement techniques used to in order to increase or decrease these flow times. So understand the advantages and disadvantages to holding cash and some of the ways to invest idle cash. So we all know that cash in your hand is having no returns on it. You cannot earn anything. But if you place it somewhere in your investment, you earn interest, even if it is very low. But consider in your mind these businesses like those like a Canadian superstore or any other retail businesses in which the millions of dollars are collected every day. And if they are not investing that cash, so it means that they are not earning anything on that. Even if they earn 0.001% interest, if the transaction is of a millions of dollars, so there is a huge amount involved in it. Like you can say that some millions or some hundred thousands are involved if they lose it. So that's the important thing. You have to keep it in mind. Reasons for holding cash. Now, why do we hold cash? It's Keynesian theory. Keynesian presented in Modern Economics, a theory, and in his book in 1936, journal Journal Theory of Employment, Interest, and Income and Money. So, Journal Theory of Employment, Interest, and Income, in which Keynesian produced these three motives of holding cash. Three motives of holding cash. The first one is a speculative motive. Now, this speculative motive means that you have some cash, and if there is any opportunity appears that you can buy and sell something, you need cash to buy something and then you can sell it and make a money out of it, or you can buy invest it for a while and then you can disinvest and make a money out of it. So if there is any opportunity, like if you like something and you want to buy it, if you don't have uh, um, uh, money with you, you cannot do that transaction. So it's important that every one of us holds some money in order to take an advantage of unexpected opportunity, right? That's what we call it as a speculative motive. The second one is called as a precautionary motive. Like we hold some money in cash or in our bank accounts in order to meet uh, any event in which you need to spend money, for any emergency in which you need to spend money. Let's assume that you have a zero balance in your account and you have a zero balance in your wallet, and flat, your tire is going to be flat, and you want to repair it. From where you make this payment? Either you use a credit card, so it means you borrow money. So otherwise, if you have a money, then you can spend. So any money we hold in order to meet these type of emergencies, it can be a bigger one as well, but I gave you an example of just a small one. So that is called as a precautionary money. Hold cash in case of emergencies. And the third one, according to the Keynes, uh, transaction motive, hold cash to pay the day-to-day bills. We need cash today to do our groceries. We need cash in order to do our to buy our lunch or to buy our uh, dinner or all these things, that what we are buying to buy our gas or all these things, right? This is what we call it as a transaction motive. We need money to do these all transactions. So uh, this is what we call it as there are three needs why we hold money. One is speculative, the other one is precautionary, and the third one is transactionary. So uh, speculative, precautionary, and transactive or transaction nature motives that keep us. Now, why we are saying that it is important to make a good decision to how much money you want to hold? Because it's a trade-off. It's a trade-off. Like, why not businesses keep all the money in cash? Because it's a trade-off. Idle opportunity of holding cash relative to the transaction cost of converting marketable securities for cash for transaction. So if these markets are, if the capital markets are very efficient, or if these bond markets or all other types of assets markets are very efficient, like when we need money, we can encash those assets, then people are not going to keep that money in cash. They invest those because they have to make a trade-off that how much money, if we convert this, how much time we need, how much money we lose, or how much money we gain against that if we keep the cash. So if this is a trade-off between holding a cash and investing in a marketable securities or the securities where we can convert it into cash. Now, target cash balance, mostly the businesses define their target cash balance, that how much they need that the cash should be in their accounts. And individually also we do this, that how much $100, $200, $300 at least we have in our bank account, so that we are. So a firm desired cash level as determined by the trade-off between carrying cost and shortage cost. So last time we discussed that there is a two cost attached with the cash management. One is called as a carrying cost. Like if you carry the cash, you are losing interest, you are losing the opportunity of investing somewhere. So that's what we call it as a carrying cost. And the other one is a shortage cost. Like if you are not keeping it, then definitely you lose some opportunities. That's the same again with the inventory as well. Like if you are holding an inventory, then you have to pay the rent for the warehouse. You have to handle those, and you need a human resource to handle those inventories. And on the other hand, if you are not holding the inventory, what is going to happen? That you lose customers. That is going to be affect negatively. Sometimes uh, you not correctly anticipate your demand, and by this way you lose that opportunity. So this is what we call it as a shortage cost. So carrying cost and shortage cost applies for cash as well. So we see that we have to make a trade-off. So we adjust our cash requirements according to the if there is a shortage, we increase our cash holding, and cost associated with holding too little cash as well. Now, there are some cash which are in float. In float means they are uh, either book in one of the book, like we have a two book for maintaining our cash. One is in our hands or in our books, own books, and one is in the bank's book, like the bank is reflecting our balance, cash balance. Now, if these two balances are not tallying, and normally we do reconciliation to tally those balances, so there is a chance that we include some receipts of cash in our book, but it is not received yet in the bank account. So that type of cash is called as in float, collection float. If we make some payments to our suppliers, but those suppliers did not present these checks to our bank or to their own bank, and through collection process they want to get it. So if not yet deducted from account, so that's what we call it as a disbursement float. So the float is there. So difference between cash balance recorded in the cash account and the cash balance recorded at the bank. This is what I explained. Then we have a disbursement float, which is generated when a firm writes checks. And there is a collection float, available bank balance at the bank. Bank balance is greater than zero. Understand float continued, and this is a collection float. Check received, increase book balance before the bank credit the account. So this is our what we call it as a collection float. Available balance at bank is less than zero. Is less than zero means that it's different than what you are reporting. And there's a net float. The idea of a net float, that what's a net float? So net float is a disbursement float minus plus collection float. So disbursement float plus collection float, that is our net float. that how much money is in float. And float benefits the banks or benefits the collection agencies. So this is the first question. Like if you see, if I so you have a 3,000 in your checking account. You just deposited 2,000 and wrote a check of 2,500. So three informations are given very carefully. Three information. One is that we already have this much amount in our bank. We further deposit 2,000 and we issue a check of 2,500. Now, as I mentioned, what is the disbursement float is a 2,500 because we write a check on it, right? But not yet deposited and withdraw from our account. So this is what we call it as a disbursement float. What is a collection float? This 2,000 check we deposited but not yet credited in our account. This is what we call it as a collection float. Now, what we want to find out net float. So net float is 2,500 is a positive plus minus 2,000 is negative. So it's going to be 500 positive. The net float is $500. And what is your book balance? Now, book balance is still appearing as 3,000. The book balance is still appearing as, sorry, this is our book. So our book balance is 3,000 plus 2,000 minus 2,500. So it's going to be 2,500. That is going to be 2,500 our book balance. And what is your available bank balance? Available bank balance is still 3,000. It's not affected because it's still in float, the collection and the. So if I repeat it once in order to make it clear and erase all these things and give you a clear idea that what I am talking. Okay, let's. What is our disbursement float? 2,500. Why? Because a check written, but not withdrawn from our account. What is a collection float? We deposited 2,000 check, but not yet deposited in our account. The net float is 2,500 minus 2,000. So we see here the net float is 500 positive. What is your book balance? Book balance is 3,000 balance. We deposited 2,000. We withdraw 2,005. We write a check. We wrote a check and we see here that it is 2,500. And a book balance available is still 3,000 because no change until the check is withdrawn and the amount is collected. You see, this is what we are discussing here. So size of a float depends on the dollar amount and the time delay. The size of the float is definitely, as I told you in the beginning, those firms who are operating to deal daily with millions of dollars of collection, millions of dollars of payments. So in that case, the float is very important to understand. The size of float depends on the dollar amount and the time delay. So delay, how we calculate the delay time. Like we are thinking a scenario in which there is not online, but a checking, like mailing time, like you send a check, physical check through mail, through Canada Post, plus processing time, like you process this check and then deposit it into your account, and the bank takes time to collect it, and this is available delay. So these are the three things that can cause a delay in our money to receive in our account. Suppose you mail a check of 1,000 and it takes 3 days to reach to its destination, 1 day to process, and 1 day before the bank will make the cash available. So how much is the wait or delay is 3 days plus 1 days plus 1 day. So 3 day plus 1 day plus 1 day is going to be 5 days. Right? What is an average day daily float, assuming 30 days of month? Now daily float is 1,000 multiply by 5 divided by 30, that is going to be our daily float. Is delay into the amount of the float divided by the month, days, and this is a 30-day month. So we 30 days month, so we can say it's a 166.67. There is another method in which we can also apply that we divide 5 into 30 into 1000 plus 25 over 30 into 0, that's going to be 166. Now, cost of float. This is what we calculate just the daily float. Now, cost of the float can be also considered opportunity cost of not being able to use the money, and we apply with some interest rates. So suppose the average daily float is 3 million with the weighted average delay of 5 days. And what is the total amount unavailable to earn interest? So it's going to be 3 into 5 into divided by 30. So 15 million. So it's already weighted average. So 13 million. So what is an NPV of the project that can reduce the delay by 3 days if the cost is 8 million? Immediate cash inflow with the decrease in 3 days is 9 million. You see why? Because we are reducing and this 3 million. The average daily float is 3 million for 5 days. Reduce the delay by three days. Reduce the delay by 3 days means introducing to 2 days out of 5 days. So how much we are saving? We are saving 3 days into 3 million. So we are saving 9 million float. So how we can do this? It's NPV is 1 million positive. So we can go for this project because it's a positive NPV. 8 million is the cost, 9 million is the saving. So we can say that 1 million is ultimately saved. Now this diagram is reflecting this cash check collection process. So customer mail payment through check, and how much. So when we receive this check, this is the whole time, and we divide it into three broader areas. So one is the mail delay or a mail float, and the other one is a processing delay or a processing company received payment and company deposit payment. This is processing float, and then we have a cash clearing delay or a availability float. So these are the three floats: mail float, processing float, and availability float. Or we can say that there are three different delays: mail delay, processing delay, and the clearing delay. Clearing is a process. We know that clearing is a process through which bank clear the checks drawn on each other. Like TD Bank is collecting a check from Scotia Bank or BMO Bank. So all these checks, they're going to send it to through clearing agency to these respective banks and get payment from those respective banks, and also make payment to those banks because the checks are drawn in a network, like because people have a different bank accounts and they are making different payments, and through online as well. Like if I make a payment at a shop, they have an account in Scotiabank, and I have an account with the BMO Bank. So when I do the transaction, the money should transfer from my BMO account to the Scotiabank through this platform, which is the machine provider or a POS provider. So this is the way that money transfer from one bank to another bank. So one of the goal of a float management is to try and reduce the collection delay. And there are several techniques that can reduce various parts of the delay. Now, ways to reduce float time: over the counter system, like you encourage the customers, they not mail you the check, they come there and pay cash or the deposit check directly. Then there is a system. Nowadays, it's not so common, but in olden days, there are some lock boxes are available at different gas stations or at different malls in order to make payment to your credit cards. So what you have to do, you draw a check in favor of your credit card company, whatever the bank is. So you write it down, the name, and do the sign and write the amount and put it in an envelope and seal the envelope and then put the envelope into that lock boxes. So what they do normally at the end of the day, they collect those, or during the day, they collect those envelopes and take it to the processing center, and then they open these and process it, and finally they make a collection through this. Nowadays, mostly the electronic collection system is working. Mostly what we are doing, we are using credit card to make payments, per pre-authorized payment cards. We are using our accounts to pre-authorize the payments, like on that day, transfer this much amount of money to my other account, or to this account, or to this person, or to this organization. We can give outstanding instructions to the banks so that they can make payment on regular basis. That's a pre-authorized. Point of sale transfers with a debit card and the electronic trade payables, that is also possible nowadays to transfer. Now, accelerating collection, that is one way to reduce this delay or a float of cash for collection, that how we can accelerate. So we see here, this is an example. Your company does business nationally, and currently all checks are sent to the headquarter in Toronto. You are considering a lockbox system that will have check processed in Vancouver and Halifax. So the Toronto office will continue to process the checks it receives in-house. Now, what is going to happen? Collection time will be reduced by 2 days on average, and delay interest rate on T-bills is 0.01%. Average number of daily payments to each box is around 5,000, and average size of the payment is 500. So 500 multiplied by 5,000, that's gonna the collection every day. The processing fee is $10 per check plus, sorry, 0.10 per check plus $10 to wire fund to a central bank at the end of the each day. So what is going to happen at the end of the day? Whatever they collected, they transferred it to the central location. Now, what are the benefits? That average daily collection is going to be reduced. Average daily collection is 7,500, and increase bank balance by 2 into this. So we can see that 2 days reduction in, no, 3 days reduction, 3 days reduction. Collection will be reduced by 2 days. So that's why we are writing it here, 2 days, sorry, 2 days. Three collection centers, three collection centers. This is the average number of checks, and this is the average amount of checks. So by this way, this multiply by this, multiply by this, that is going to increase in our cash availability for cash, average daily collection. And if we reduce by 2 days, so it means we enhance our cash availability by 15 million. Now, what is the cost of this? Daily cost is like we have to pay 0.101 percent for 1 day, because out of 3 days we are reducing. So 1 day, 15,000 plus 3 into 10, these three locations, 10 per check. So these are the number of checks, right? And this is per check we have to pay. And this is the three locations, $10 wire transfer. So this is the daily cost of transferring the money, or presenting value of the daily cost is, present value of daily cost is when we discount it with the T-bill rate. So we see that it is 15.30 million. And when we compare with the NPV, which is the gain, this is our gain and this is our cost. So we see that the cost is higher than the gain. So we are not going, the company should not accept this because the NPV is negative. NPV is negative, so we reject this proposal or this project. Now we can also, so what we learn here in that the collection, because if we enhance or accelerate the collection period, that is beneficial. But if we increase the disbursement period, that is also going to be bad. Slow down payment can increase disbursement float, but it may not be ethical or optimal to do this, because that is going to affect your customers or suppliers negatively. We can control disbursement by zero balance account transfer. So we maintain 2, 3 accounts, and in which daily we transfer it to make it a zero balance out of it. Control disbursement account, and these are the techniques through which we can decrease the disbursement. Invest idle cash. Where do we can invest our idle cash so that we can uh, utilize our cash more efficiently? Money market, that is another option available that we can use to invest financial instruments with an original maturity of 1 year or less. Temporary cash surpluses, if we have a temporary cash surpluses, we can invest. Seasonal or cyclical activities, buy marketable securities with the seasonal surpluses and convert securities back to cash when deficit occurs. Planned or a possible expenditure, accumulate marketable securities in anticipation of upcoming expenses. And this graph is going to represent, like we discussed last time, short-term financing, how we required. So there is a conservative policy, there is a flexible policy, and we see that this is a long-term, this straight line is our long-term financing. And the difference between the straight line and these cyclical or seasonal changes is going to be short-term financing. If we are above this point of long-term financing available, then what we do, we go for a bank loan in order to meet this deficit area. And if it is below this required, then we can invest in marketable securities. And that's the best thing, that we are not keep any idle cash. We invest it if there is a surplus. And if we are short of that, we can borrow short term from our financial institutions. So maturity firms often limit the maturity of a short-term investment to 90 days to avoid loss of a principal due to changing interest rates. And default risk, avoid investing in marketable securities with a significant default risk. So we have to avoid those. Marketability, easy of converting to cash, and taxability. So where do we invest? What the characteristics we have to look after when we are investing our short-term idle cash. One thing is that the maturity should be of 90 days, not more than that, because the interest rates are fluctuating during that time, because it's short term. The interest rates are fluctuating. Also, we not invest on those which have a high risk of default. That's the requirement we have to take care of. And the third one is a marketability. How quickly, how easily we can convert those securities into cash. That is the third requirement. And the fourth one, if there is any advantage that we can gain and for tax purposes or for our tax liabilities, reduce our tax liabilities, in that case, we go for consider different tax characteristics when making a decision. So if we summarize what we discussed so far, it's a simple short chapter discussing the things which are a little bit obsolete nowadays, but we have to understand that. So by moving cash efficiently and maximize the amount available for short-term investment, the traders add value to the firm. A firm hold cash to conduct transactions. Net float is the difference between firm's available balance and its book balance. And optimal cash level depends on the opportunity cost of holding cash and the uncertainty of future cash flows. So this is all about discussing today's uh, class, the theoretical part or the things that we can discuss.